Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the effective interest rate calculation. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you'd like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 814 Effective Interest Rate tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We'll use that information to work through the practice problems on down below. We're going to be calculating the effective interest rate. The effective interest rate calculation is a fairly straightforward calculation, and we're going to use a straightforward example here to do so. But this calculation can then be modified and used in order to make scenarios that are different to be in the same kind of standard. So we can compare basically the same thing to the same thing. For example, if we had a loan that had a fee related to it, we can use an example like this for the effective interest rate type of calculation to consider what the effect of that fee would be if we were to compare one loan to another loan, one which has a fee, one which doesn't have a fee. How can we standardize those items? Or if we had a discounted loan, which is going to be a little bit different format of the loan structure, then how can we basically standardize so we can be comparing the same thing to the same thing? The effective interest rate is one type of calculation that is very useful in that regard. So the information we're going to have is going to be this in our example problem, and then we'll apply it to some of those more complex type of examples in future presentations. So we got the bank could loan the company cash of $5,000. So the loan's going to be $5,000. We're talking a loan for less than a year. So the days of the loan are going to be 70 days of the loan. The interest, not the rate, but the interest amount is going to be $60. Now, if we know what basically the interest amount, or in other words, we can basically call it the cost of the loan, which is the interest, the rent we are paying on the money that we are receiving. If we know that dollar amount, then we can try to figure out what the effective interest rate is. And this is going to be one of the key factors where we can use to kind of modify our calculations to compare different types of scenarios where they might be saying, well, the cost of the loan is the interest that you would calculate plus a fee. Now you got the interest plus the fee that's going to be the cost of the loan. Or if there's different structures to the loan where they basically have a discounted loan where they take the interest up front or something like that, that's going to change the dynamics of the loan. And we have to then think about, okay, what's the cost of the loan, which is typically called the interest, but what's the cost of the loan in whatever case you want to put that in, and then think about the relationship to get the effective interest rate so that we can compare this thing out. Now there's two formulas we'll take a look at. They're derived from the same formula, of course. So you can think of our normal calculation for interest, which is often the starting point. So you could start with interest equals principals times rate times time. So you know that the principal represents basically and usually the loan amount. If you're talking about the loan from the starting point, the principal, the amount you owe on the loan. The rate, remember that the rate means the rate for an entire year. That's the standard of what a rate is. So when you hear the interest rate, it means for an entire year unless stated otherwise. So the rate basically per year. And then time is actually a fraction. Time is going to be the fraction of a year. In our case, we're talking about loans that are less than a year. So we're talking about basically the fraction of a year in our case here. So we're going to then say, if I was to solve for any of these, they can give us any item. Obviously, if we have one unknown, we could solve for the unknown. So in this case, we're going to solve for R being the unknown. So if we use our algebra to solve for R, we would then have R, the rate, this is going to be the yearly rate we're talking about, right, equals the interest, the amount of interest divided by the principal or loan amount times T, and in this case, T is a fraction because it's going to be the fraction of a year that we have here. Now, note again, if you have this formula up top, you can also solve if they didn't give you the loan amount and they told you just basically the interest, the rate, and the time, then you could solve for the P, which would be the loan amount. And if you didn't know the time, you could solve for T. That would be a little bit more unusual, but this can always be your starting point. So if you memorize this formula, then you can move from there. Now that we have this formula, we can plug it into this format, and you can obviously just plug the numbers into this format. It might be useful sometimes to break it out even further into basically a format like this to the left, which is basically taking this time component, because remember that time component is actually a fraction. It's going to be the days in the year 70 divided by the total days, or the 360. and we can take the inverse of that fraction and put it over here, basically. So this is the inverse of the time calculation. If we do that, we're left with interest over principal times the days in a year, 360, over the days the loan is outstanding, the inverse of the fraction of the year on this side. So we'll do it in this format. We'll break it out in this format, and then we'll do it again in this format. And again, both of these formats you could derive from basically this initial formula, which is probably the basic formula that you would have, memorized. You want to make sure you memorize this, and then if you can, pick this up. But if not, derive it, and then you can pick it up here. So we'll start off with this formula. This is a little bit more detailed of a formula because we're going to write it out here, and I think it's easier to see kind of the differences we will have in the future when we do it. But then we'll put it into this format as well. Now, obviously, you could just do the algebra, plug this in algebraically. I highly recommend, I'm going to put it in a table format as if we're going to make a little worksheet on it, like a tax return type of worksheet, step-by-step calculation in a vertical format. I think it's very useful to do that, and I would recommend practice doing that in Excel. We do have these in Excel, or a similar example in Excel to do that, because then it'll help you to see each component of the problem, and it'll help you if you want to put a worksheet together so that you can use it in your business. Any kind of worksheet, you can take a formula and put it into this format and then use your data to change the data to rework your numbers. So what we're going to do is we're going to take the first half over here, we're going to put that on the inner side, and then I'm going to take the result of it and put it on the outside, and we'll just do the algebra in a table format. So we're going to say the interest. This is going to be the interest first. We're going to divide that by the principal, which is the loan amount. So the principal is the loan amount of the $5,000 in our case. If we divide that out, the 60 divided by the 5,000, these are typically going to be a small subtotal number here. So we're going to have a fairly small number here. We're going to say, obviously, it's going to be the 60 over the 5,000. It's going to be the 0.012. Then we're going to take the other half, which is the inverse of the time calculation. So this time here that we basically flipped, inverse, and now we got the 360 year, 360 days. That's assuming nice even 30-day months. 30 days times 12 gives us 360. And then we're going to say the days of the loan are 70. That's how long the loan is outstanding, 70-day loan. So then if we take the 360 over the 70, we're going to take the 360 over 70. We get 5.1428 and so on. And then I can multiply these two together. They're both on the outer column now. So we'll multiply those two together times the 0.012. And that's going to give us then our, if I move the decimal over, 6.17%, 6.17 about. Now, if I was to replug this in and just test it, I can say, let's plug it back in and calculate our interest, which should be 60. So if we recalculate the 60, we're going to say, all right, it's going to be, we have to, the time is really the percentage of a year. So let's do that first. So the time is actually going to be the interest, or the days in a year, 70 divided by 360. The days of the loan divided by the days in the year is time. So time comes out, the fraction of the year is about 0.19. So if I took that times the rate, which is about, this is rounded, so it's going to be 0.0617 if I move the decimal over, times, and then we've got the loan amount, which was 5,000 times 5,000. We get about 60, because again, this is a rounded number, so about 60, so we can kind of double check that. All right, so then we can do the same calculation. Let's do it in this format. Let's do this format of the calculation. So we took our original formula, we solved for R, so now we have R equals interest divided by the principal or loan amount times time, and time is a fraction, so time's going to be that fraction we saw, which is going to be 70 over 360. So we'll say, all right, so R then, the interest is 60. We know what the interest is. We know the cost of the loan amount, which is going to be the 60. We are going to put that in the outer column here because that's going to be our top number, our interest. Then we'll do the subcalculation of principal and interest and time, principal and time. And time's going to need another subcalculation. So the principal or loan amount is 5,000. And then we're going to do another subcalculation related to time because it's going to be a fraction of a year. So we're going to take the days of the loan, which was 70, the days in a year, which is going to be 360 about, because we're going to assume even months, 30 days times 12 as opposed to 365 days. We got the 70 divided by the 360 gives us about, if we make it into a percent, 19.444. Otherwise, it would be in a decimal format. And then that's going to give us then, now we can multiply these together. Principal times time, 5,000 times 19.44%. So let's do that over here in the calculator real quick. If I took the 70 over the 360 in decimal format, we get this, times the 5,000. We've got the 972.22. So then we can take the interest divided by that number. So now we're gonna take the interest 60 divided by the 972.22 is gonna give us, if I move the decimal over, about 6.17%. And again, we can prove that by plugging it back into our interest formula, and we should get back to 60. So if I take the percent rate times the principal, which is times the 5,000, times time, which we now know is a fraction of a year, 70 divided by 360, which is 0.19444, so times 0.1944444 on forever, we get about 60, right? Because there's rounding involved. So we've kind of double checked it. So there's our calculation. Let's do it again. Let's just have another example of it, where now we're going to say the loan amount is 3,000, the days of the loan are 40, the interest is going to be 35. So once again, they gave us the interest, and the interest is going to be whatever the cost of the loan is. So if we know what the cost of the loan is, which is usually interest, the rent of the loan that we're going to have to pay, then we can think about it, and we're looking at a loan that's less than a year in this case. So we're going to say, once again, we can use either of these formulas. We've derived it from the same place. Interest equals principal or loan times rate, yearly rate times time, which is a fraction of a year, which is R. You can have the rate equals interest divided by the principal or loan times T, which you can then take this fraction, if you would like to, and break it out in this format, which would be interest over principal times the inverse of that time ratio, days in a year, 360 instead of 365. You might see 365 sometimes, divided by the days loan is outstanding. So let's do this calculation first, and then we'll do it in this format. So we're going to say, all right, if I have the interest, we have 35. That's what we're going to pay in interest. They just gave us what they're going to pay in interest. So then we're going to say, well, what would basically the rate be? And so if we have the effective interest rate. So we're going to take that and compare it to the principal. So 35 divided by the principal is going to give us our first half of this. If we were to divide that out, we're going to get, of course, the 35 divided by 3,000 is going to be the 0.11667. And then the second half is the days in a year, which we're going to assume 12 times 30 or 360 divided the days of the loan, which was 40. So this is the inverse of that time factor. So now we're going to take the 360 over 40, which is going to give us 9. Now we have the two components of our calculation that we can multiply together. So 9 times 0.011667 is going to give us about the 10.50%, right? And then if I was to prove that, I could say, okay, well now let me plug that back into my interest formula to solve for I and see if I do indeed get 35. So we can say, all right, let's start with the time, because it's going to be a fraction of a year. It's going to be 40 days over 360, which is 11% of the year. And then I'm going to take that and multiply it times the principal, which is 3,000, the loan amount. Take that times the rate, which is about, I'm going to say times, if I move the decimal over, 0.105, and that's going to give us 35. So there's our 35. We've recalculated it, so we kind of double checked it. Let's do the same thing and use this formula. R equals I divided by P times T. So we're not taking the next step of breaking T out and taking the inverse over here. We're just going to leave it this way, remembering that interest is going to be interest, principal is a loan amount, T is going to be that fraction of a year. So we'll say the interest is 35 again. We already know that. They just gave us the amount of it. We're going to back into the rate now. The principal is going to be the 3,000. So we're going to do in the inside now. 3,000 times time. Time is going to be a ratio, so I'm going to pull that into the inside to calculate time. It's going to be the days in the loan, 40, compared to the days in a year, 360, which gives us the percent of the year, 11% that we saw the fraction of a year or the percentage of the year. So then if we take the 3,000 times the 11%, 11.111%, we get the subtotal of 333.33, and now we can take the 35 divided by p times t. So 35 divided by p times t is going to give us then that 10.5. So if I was to do that, I'm going to say, all right, 35 divided by 333.33, and that's going to give us about our 10.5. Now, if I plug that back into our formula up here, we're going to say, all right, the loan was 3,000, I believe, times the rate, which is going to be 0.105, times time, which is 40 divided by the 360, or 11.111%, or 0.111111111 on forever or whatever. And that gives us our 35, recalculating the 35. So useful calculation there. Again, if this interest cost of the loan is something something different, right? If we have not a normal kind of simple interest calculation, then we can figure out what the interest would be, the cost of the loan, whether that be fees that are included in it or whatnot. And we can use this calculation to basically standardize the effective interest rate. And once we have the effective interest rate, we can compare it to other loans as if basically they're all kind of normal loans. We could standardize the costs of different types of loans. That's our point, to try to make the best decision as to which loan to take, even though the loans are set up in funny ways, such as having a discounted loan or including fees in the loan or something like that.